A new survey from the Federal Reserve found that lenders are getting stricter when it comes to consumer loans. The rejection rate for credit applicants increased to almost 22% in June. That is the highest level since June of 2018. The rejection rate for auto loans increased about 14% from just over 9% in February. There was also an increase in rejections for mortgages and mortgage refinance application. Warren Kornfeld joins us now. He's the Senior Vice President for Moody's Investor Service. Okay, so what is behind this? Are they just doing us a favor?
So it's really quite straightforward. If banks expect unemployment rates to rise, they're going to tighten their lending standards to go and reduce possible future losses. Now, let's go back a little bit. 12, 18 months ago, U.S. consumers were in the best shape, financial shape they've been in 50 some odd years, if not ever. We had excess savings. We had unemployment rates had fallen to less than 4%. And the best way, in my view, to tell how are consumers doing is, are they paying their financial obligation? And at that point in time, delinquencies on cards, autos, residential mortgages were at historic lows. So since then, we have obviously had the last 2 years elevated inflation. The Fed has increased rates. Why? To slow the economy. Therefore, we have higher recession odds. And banks started tightening, actually, underwriting standards, credit standards, about a year ago.
And does the turmoil that we've been seeing in the banking world impact this? I mean, are banks themselves making this call because of everything that's been going on in that sector?
So remember, it did start before with just the deteriorating macroeconomic prospects. But absolutely, the turmoil that we had back in March and April in the banking sector has had an impact. What do banks do? They borrow money, mainly deposits. What do they do with that money? They lend that money out to consumers as well as businesses. So back in March and April, a whole variety of different things happened. Depositors woke up and started demanding higher rates. Depositors were questioning, should I keep my money in Bank X or should I move it into Bank Y? Depositors looking at yields and money market funds, and we're transferring money from deposits into money market funds. And thanks to all this, we're concerned with the stability of their deposits. And reaction, banks look to slow their loan growth. And the fastest way to slow the loan growth is with tighter standards.
And does the Fed's tightening regulation on banks also play a role?
Absolutely. So banks have been increasing. Have been reducing share repurchases the last quarter or so in anticipation of tighter regulation. And, with capital standards likely for the largest banks, over $100 billion or so, likely increasing. We will find out in a day or so, likely on Thursday for the latest round. Banks are looking to, yes, conserve, not have their balance sheets grow. And yes, that's also having an impact on bank lending standards.
Very quickly, if you're rejected, do you apply again? Do you go to another bank before I let you go?
Yes, you do. There's a wide variety of different lenders out there, banks as well as non-banks. And yes, you do try again.
If at first you don't succeed. All right. Warren Kornfeld, thank you so much.